Hello, everyone. Welcome to the third part in the educational series, Business Structure of Business Classification. My name is Aisha Sardar, and I'm the founder of Public Allies. Public Allies is a nonprofit established to help and support for a community to live together in harmony. Our primary objective is to provide help and support to the most vulnerable members of the society to overcome their challenges. Today we have with us our experts, Andrea, Jaina, and Neeru. And I will let them introduce themselves because it's a long list in the introduction. So Andrea, can you tell us something about yourself?
Yeah, sure, Aisha. Thank you very much. Hello, everyone, and welcome to our webinar tonight. My name is Andrea Vladescu. I'm an accountant. I help small businesses and individuals to manage their financial health and growth by offering accounting services and tax planning and preparation services. Before I start my professional practice, I worked for 20 years as an accountant in doing financial reporting, cash flow management, internal controls for both profit and not-for-profit organization, assisting with accounting software implementation as well. Currently, I help individuals and small businesses to capture all allowable deduction in order to minimize their tax payment and help them on to stay on top of all the updates regarding personal and corporate tax return. I also help small businesses understand better their company's current situation by providing a detailed analysis of key performance indicators, which is very important, and many small business owners oversee this step. I prepare financial statements in compliance with GAAP, Generally Accounting Accepted Principle. And this is, in general terms, what I'm doing. I will pass it now to Neeru and another expert tonight in our webinar.
Hello, everybody. My name is Neeru Padmanabhan. I am a financial professional. I have been a financial professional for almost 2 years now, about a year and a half. Before I became a financial professional, I actually worked in social services. So I was a case manager at shelters. I worked in immigration programs. I worked in battered women's programs. I just had a long career, about 14 to 15 years in social services and additional years volunteering. One of the reasons why I became a financial professional is because a lot of regular people would end up on my caseload. Families that faced a little bit of tragedy, one or two things happened and they just didn't realize things spun out of control. But 50% of my caseload was seniors. And business owners would come into the shelter. They would, you just wouldn't believe the type of individuals we see. I saw teachers, I saw medical professionals. You just can't see. You can't decide and say this person's never going to end up in a bad situation. And when I really looked at it, really chalked it up, I found out that it had more to do with your financial knowledge. And I realized that we in society don't really do enough about financial education. We don't have access to the right tools. There's nobody sitting there trying to help you figure out the way to do things. So that's why we decided to do these webinars and help educate individuals on their financial situation so they don't end up in bad situations. They know where to turn if things are starting to go wrong, or just have a plan set from the beginning and access somebody like Andrea, Jaina, myself, access an individual that works with mental health like Aisha. So there's so many ways to help yourself. So hopefully this will be educational, and I'm going to pass it off to Jaina.
Hi, everyone. I'm just gonna, there we go. I'm Jaina Sang. I am a lawyer. I've been in practice for 11 years or so. And throughout the course of my practice, I was with a small firm when I first started off into the legal world. And that's where I cut my teeth and got a lot of experience in family law, wills and estates, and also some corporate. And I also spent 2 years as in-house counsel for a small company. So really got to see sort of the intricate workings of a small to medium-sized business, and you know, where things work, where things sometimes fall short, and where there are gaps. And one of the reasons why the three of us decided to put these webinars together is because we feel that, you know, when people set out a goal for themselves, whether it's like, you know, starting your own business, or moving to a new country, or, you know, whatever situation that they're in, you know, they often have to talk to a lot of different professionals and sort of get information in silos. So like, you know, you get a little bit of information here, you get a little bit of information there, but sometimes there isn't really that one person, or the people that they're talking to aren't there to really work with other professionals that is in this particular person's life to help them come up with a cohesive plan that makes sense and that works across all facets of you know, their life, whether it's business or personal. And that's part of the reason, and one of the biggest motivators for us in putting these webinars together, is to try to help people get information, not just from, you know, my very narrow view of like, you know, the legal side of things, and we try to, you know, bring in all sort of the different considerations and aspects across finance, across accounting, all the important things that someone needs to think about when starting their own business. So hopefully you'll be able to get something from this today. And as Niru and Andrea has already mentioned, if you have questions, you know, don't hesitate to reach out to us. We don't necessarily always charge for, you know, every phone call that we have, but you know, there is some cost to, you know, getting advice, obviously, but at the same time, you know, we're happy to help with general information.
Thank you so much, Gina and Niru. So let's begin. Let's learn more about the business structure, and it's on to you guys.
I'm just gonna share our slideshow. Okay. Take it away, Gina.
All right, great. So as you guys can see, we're talking about the different types of business structures in Canada today, and we're looking at it from a lens of the legal, tax, and financial aspects. And as I stated earlier, again, we're providing this webinar as general information. We're not providing you with professional or legal advice. So if, you know, there is something that you want to find more information on, you know, reach out to one of us or reach out to a professional that your question pertains to. Next slide. And again, I just wanted to thank Aisha on behalf of three of us for allowing us to run this webinar on your platform. Public Allies is an amazing organization, so I hope everybody checks them out as well. All right, and that's
here's
just
how you contact Jana, myself, and Andrea. We'll play these back at the end. And take it away, Jana.
okay. It's actually going to be Andrea that starts us off.
My apologies. Go ahead, Andrea. You're muted. There we go.
Yeah. Do you hear me now?
Yeah.
Okay. I would like to start with small housekeeping items and mention that because it's a short presentation, I kindly ask the participants to save the questions to the end or write the question in the chat, and we'll address it as soon as three of us will finish the presentation. So thank you for this favor. And let's start now with our presentation of business structure. So we are going to cover today sole proprietorship, legal, tax, and financial aspects. And then we are going to go through partnership, corporation, and not-for-profit. Because it's a busy agenda, let's start with the sole proprietorship. And I will start by saying that is the simplest kind of business structure. in order to register for as a sole proprietor, you need to you can use your own name with no additions, but if you like to call it anything else, like your business, then your business must be registered. A name registration does not protect your business name or guarantee exclusivity. For that, you need to apply for a trademark, and usually that takes some time. So just be prepared and patient. Also, if you like to have a different name than your own, you can do a business search on Nuance, which stands for New Upgraded Automated Name Search. It's a Canada-wide corporate and business name registry. Over a small fee, you can search if any other businesses in Ontario or other provinces has the name that you want to pick for your business. And if that name exists, you cannot take it, you have to change it, to think of something else. If it doesn't exist, you are lucky, and you can go ahead and with registration process further. Once your business registration is complete, you will receive a master business license, which is the proof of the business name registration for financial institutions. So then you can go to the bank, open an account on the business name, and if your industry requires any licenses, you can apply for licenses, all the other steps. I just want to emphasize that the master business license needs to be renewed every 5 years. So every 5 years, it will expire, and if you don't renew it, you can incur penalties. You really have to make it on your calendar and as a reminder, and make sure you don't forget this. On the next slide, I will mention, next slide, Niru, please.
Mm-hmm.
I will mention about a sole proprietorship characteristic. You are personally liable for the activities of your company, and you will assume all the risk as a sole proprietorship. You pay personal income tax on the net income generated by your business, and for that you need to file a T1, it's called income tax and benefit return, and there is a form T2125 which will list all your business expenses, sales, all the revenue. That is something that an accountant may help you with, or if you have enough knowledge, you can do it yourself as well. As a sole proprietor, you also need to make CPP contributions, which is for contribution for pension plan. And in 2020, the amount for that is $5,796 for a maximum pensionable annual earnings of $58,700. Also, as a sole proprietorship, you are required to register for GST/HST, which is a sales tax. If you exceed the 30,000 threshold in sales over 4 consecutive calendar quarters. So as long as your business per year is less than 30,000, you are not required. The moment you hit that target, 30,000, you need to register for GST/HST and then do reporting. So there are lots of other things involved when you hit that target. Also, make sure, my advice is make sure that you keep good records to show what income and expenses are related to the business and which one are personal, because, and much suggested is to open a separate bank account, even though your business has your own name, and do all the transactions related to the business through that bank account, so you can keep separate and don't mix things up, because it's very easy to to forget, what did you purchase for company, what did you for the business, what did you purchase for personal needs. Self-employed individuals and their spouse or common law partners have until June 15 of each year, of the following year, let's say, if you're filing for 2019, June 15 of 2020, to file the income tax return. However, if you have something to pay, like if you owe something in tax, then the due date is April the 30th. So it's better to do all the calculation before April the 30th. If you don't have anything to do, you can send the report on June 15. But if you have something to pay, be sure that you are paying on April 30th or before. Otherwise, after this date, these days, CRA is going to charge penalties and more expenses from your pocket that you can control, So next slide. I would like to emphasize about motor vehicle expenses, because lately CRA is doing lots of audits on self-employed deduction for motor vehicles and home expenses. So these are the two main deduction that I would like to focus on this small presentation. So you can deduct motor vehicle expenses only when they are reasonable and you have receipts to support them. Also, CRA requests a logbook where you have to keep the following information: the date when the expense or the trip incur, destination, purpose of the trip, like to meet a client or to do any other business related activity, and numbers of kilometers you drive. If you don't have this, you don't keep that logbook, and CRA, let's say, will audit you, they will deny the expense, and then that deduction cannot apply to your income tax. So you will have to pay more taxes and for sure penalties and interest. So that is very important to keep in mind. Always do an odometer reading of each vehicle you have. For example, you have for business, I mean, for business purpose, you use one or two vehicles, you have employees, you have other people that are working for the business. But for each vehicle, keep a separate log and keep the odometer reading very accurate all the time. Always the important date is the end of the fiscal period. It depends when you declare your fiscal period. Most of the sole proprietorship are having the year end on December 31st. There are exceptions. It depends how they choose to declare the year end. And this is for motor vehicle. On the next slide, it will be business use of home expenses. And for business deduction, those type of expenses, in order to deduct them, you need to have your principal place of business at the house you own. So that's supposed to be on the article of incorporation. The address of your business is supposed to be your house. You use the space only to earn your business income. So the room that you are using out of your house, that room should be designated only to earn your business income. You use it on a regular basis to meet your clients, customer, or patients. It depends which, if you are a professional, it depends of your type of business. You can deduct part of the following expenses: maintenance cost, which is your heating, electricity, home insurance, cleaning materials. So it's proportion with the space that you are using in the house, like that room that you are using for business. You have to see what is the proportion of that space according, related to your space in the house, and then that proportion you are going to apply for all the cost, your maintenance cost, let's say. Then property tax is the same thing. You apply that portion to your property tax bill. Mortgage interest you can deduct, and also in some cases capital cost allowance. When you decide to go on that route, the capital cost allowance, is better to check with an accountant, because there are very strict rules about this, and if the CRA will audit you and that expense is not eligible, then the deduction is not accepted, and then again you are going to pay more taxes. To calculate the part you can deduct, as I mentioned, use a reasonable basis, and do, I would say, proper measurements, and you'll be fine. You have all these documented in your permanent binder, for example, and then that will be a sufficient proof for CRA in order to have all this deduction acceptable. I will go to the next slide now, and we'll talk about freelancer, just few characteristics. First of all, what is a freelancer? Freelancer is working for different companies at different times, rather than being permanently employed by one company. As a general rule, you always need to set aside, as a freelancer, 25% of your income for taxes. You are taxed only on your net income, which is your total income minus all your expenses. In Canada, as a freelancer, you declare your freelancing payments as business income on the form T2125. As I mentioned, is the same as for sole proprietorship. This form is part of your T1 income tax return, personal income tax return. And all the deadlines are the same as the one mentioned at sole proprietorship slide. And now I'll pass it on to Jana to give you more insights about sole proprietorship legal consideration.
Thanks very much, Andrea. All right, so some legal considerations. I mean, a lot of this is sort of summarizing what Andrea has already covered, but I thought I'd approach it from a pros and cons perspective for someone who is looking to start their own business and they're now thinking about, do I want to be a sole proprietor? Do I want to go into business with somebody else via a partnership? Or is this an instance where I should set up an incorporation? So the pros of becoming a sole proprietor, first and foremost, is that it's relatively quick and it's relatively inexpensive to set up. This is something that you can do on your own relatively easily. And because you are the business, there's no need to file separate income tax returns that you would be required to do if you do incorporate, and you avoid the added administrative expense of that. And also, any non-capital business losses that you may experience can be used to offset any other income that you may have. So for example, if you still have a full-time salary job with a company, but now you're starting out and testing the waters in the side gig that you're really interested in, then any losses that you incur in that side business can be used to offset your main income. Now, the downside of being a sole proprietor is that there is unlimited liability. And what I mean by that is that because, again, because there's no distinction between you and the business, you guys are not separate entities. If there is any issues with the business, so if your business gets into trouble, if there are creditors or the business becomes sued, then any personal assets that you have in your own name can potentially be seized as well. And going further along that line, as a sole proprietor, you're personally responsible for all of the contracts of the business. So if you don't fulfill a contract, whether it's on the client side or on the supplier side, you're personally liable for it. Similarly, you're also liable for any issues or damages that are caused by someone under your employ during the course of their employment for you. And so to offset some of these risks, frequently sole proprietors should definitely look at liability insurance to help mitigate some of these potential personal risks. And last but not least, a sole proprietor business is not set up for succession. So what I mean by that is, if let's say somebody starts up a business and they set it up as a sole proprietor, and as the business grows, the intention in the back of their minds is that they want this to be a family business. They want their children to be able to take it over once they're out of school and get some experience, and to continue on in the family business. When the business is structured as a sole proprietor, if the owner, so if the sole proprietor passes away, there's no continuity of that business. So whether it's their spouse or their children, if they wanted to continue that business, they would have to reestablish the business, re-register the name, and likely in another entity, in order for the business to continue that way. Next slide, please. Okay, so what are some ways that you can protect yourself as a sole proprietor? So one of the things that I've already mentioned from the liability perspective is to look at your liability insurance options. Neera is going to talk about other insurance options as well for people personally to insure their life and offset some risk that way. A couple of other things, not so much from a legal perspective, but from a business perspective, and this will apply through all of the different business structures today. So I'll go in depth into it here, but when we get to the partnerships and corporations, I'm not going to harp on it a little too much. But what a lot of people don't really think about, especially if they're just looking at setting up their own business, is setting up and creating and establishing a disaster recovery plan. So none of us expected in March of this year that we were going to have a global-wide lockdown because of COVID-19. And a lot of businesses were not necessarily prepared for it, from a business recovery perspective, from a financial perspective. And so with this particular plan that I'm talking about, this is more so to help a business recover as quick as they can, and to put systems and structures in place such that, if something does happen, whether it's a man-made issue, so, whether there's a terrorist attack, if there's a natural disaster, like a flood or hurricane, or if there's a technological issue, so like, if you get hacked, or if you lose data, that you have some plans built in to get you back up and running, and get up to speed that way. And so as part of this disaster recovery plan, there are a couple of steps. So first step is to create a disaster recovery team. So that you're identifying people in your organization that are responsible for developing, implementing, and maintaining this disaster recovery plan. And within this particular area, there should be a document that defines each member's responsibilities during a crisis, and they should that document should also have that the team's contact information. So, phone number, address, email, cell phones, things like that. this team should be the first point of contact when there is an emergency. And as part of that as well, there should be some sort of communication flow happening such that people know, you know, let's say we get hit by a hurricane and we can't get in touch with the main owner in charge. So now who is the next in line in terms of authority? Who's responsible for communicating what the procedures are? Are we opening up the business? Are we not? Are we moving things offsite, etc.? So making sure there's a flow of information and also a flow of authority. The second step or main component of a disaster recovery plan is to identify and assess potential risks that your business may face. So like I mentioned, it could be natural disasters, it could be man-made issues, or it could be technological issues. And in terms of identifying these risks, the team should also then be building around each particular potential risk, assign a number to it in terms of, you know, how likely is it to happen, how big will, how negatively will the business be impacted, and so on and so forth. The next big component to think about and to consider is what are the business's critical applications, documents, and resources. And so the organization as a whole should evaluate its business processes to determine which ones are critical to the operation of the organization. So what needs to be brought back online first, and have a priority sequence that way. And with respect to this particular point, the focus is on short-term survivability, not necessarily, you know, anything long-term. So short-term survivability is, you know, making sure you're generating cash flow or, you know, having some sort of income come in from revenues. And another critical process is payroll, you know, making sure that your staff is still being paid. The next big component is to specify backups and offsite storage procedures if those are available and options for you. And so I've covered a little bit of some of these things already, but, you know, the big things to think about is, you know, who is in charge, who needs to be contacted, where are we moving things offsite? If we have offsite data, does everybody know where that is? When do things need to happen? How quickly? And how are things going to happen? How is data to be accessed if it's offsite storage? Last but not least, sorry, just go back, there we go. Last but not least, the biggest component is to test, review, and update the disaster recovery plan on a regular basis. You don't want to have team members on this disaster recovery plan and, you know, they are high up in the authority chain, but, you know, they no longer work for the organization. And so if something that's outdated, then that's not really going to help you in a crisis. Okay, next slide. Okay, so the business disaster recovery plan is it's one component of what I call a business continuity plan. So the business continuity plan is a larger plan around your business to, again, to make sure that, you know, if you guys do suffer any kind of setback, if there is any kind of disaster, that you have plans in place for your business that will get you guys back up and running as soon as possible. And so I've just highlighted a couple of things here. I'm not going to go through all of them in detail. So number one is the business continuity distribution list. So, you know, having the contact information for all of the key people. And that covers number two, so key contacts and notification procedures. So again, that talks about, you know, who are the primary and secondary contacts that have to be made aware of a business interruption, and what is the flow of information, who has to contact who, and, you know, there should be a communication tree trickling down such that, you know, everyone in the organization will eventually be notified. Number three, key staff roles and responsibilities. And so it's great for businesses to develop position-specific checklists and procedures that detail responsibilities for your key staff in these roles in order to go through the recovery process. And let me see here. Yeah, and I think an important thing here is that you should create task teams if your organization is big enough to cover each critical business process. Okay, next, offsite recovery locations. I've already talked a little bit about that. Recovery action plan. So here is going beyond dealing with the immediate disaster, and you have a longer recovery plan. You identify, you develop incremental processes and procedures to recover each critical business process. It would be great to have response checkline timelines, and that includes time increments, if it's possible, like, whether this process needs to be up and running, within the first hour of a disaster, within 24 hours, whatever the case may be. Okay, next is customer data. So customer data, obviously, we've seen so many privacy breaches, very important to keep safe and confidential. So, making sure that you have offsite storage and that your key personnel know where to access that offsite information, and also have the appropriate authority, like, whether it's login information or physical access to offsite data servers to be able to access information in case, like, your local computers get hacked. Primary suppliers contact list. So again, that's just makes sense to make sure that if something does happen to you, you have your primary suppliers contact list readily available, and you can get in touch with them right away. Let me just see here. Skipping down to number 9, so documentation and insurance details. Niru, I'll let Niru talk a little bit more about that, but making sure that you know where those documents are, and the key people know where the documents are, and who your insurance agent is, such that if they need to get in touch with the insurance people right away, that there's no delay in that contact. Okay, so I'm gonna skip down now to Niru.
Hi, everybody. So when we're talking about business, we want to say that Jana and Andrew have already spoke a lot about this. So I'm just going to really quickly cover again. There's not a lot of distinction between your personal finances and your business. So that's why whenever you run any business, and this is going to be true of limited, NGO, corporations, partnerships, anything that we discuss in this financial realm, I want you to keep this in mind, even if you're incorporated, even if you think your business is foolproof, each piece of your financial record needs to be balanced. So if your business is really well set, that's amazing. But your personal finances also need to be set, because they trickle off, and it'll end up causing you kind of long-term problems in both ways. So just keep that in mind, and know that both pieces need to be balanced. So when you're looking at somebody who's self-employed, it's really about your earnings, sales, commission, however you earn your wage, your deductible expenses, just like Andrea spoke, and then what's left is your net business earnings, and that's where you take your wage out of. So understanding that that's kind of how it works. And oftentimes for a lot of individuals, like Andrea and Jana have already mentioned, there's not a lot of difference between that. So when you're self-employed, and anything besides a corporation, you're a gig worker, it's a side gig, anything like that, your personal and business finances are not really separated. That's why I have a lot of focus on making the personal big here and the business small. So when you're looking at your business, you want to make sure your personal finances are set, because there's not a lot of distinction between your liability and yourself, and there's so many things that can happen there. That's why you need to make sure that you're protecting your ability to earn. You're making sure you're protecting your life, especially if you have a family, you have people that depend on you, and protecting your investments. So, and also extended health insurance. And over on the business side, making sure there's some type of business overhead expense or liability insurance, making sure that there's business accounts set up. So separate accounts, I don't always tell people that they have to, but if they can, it doesn't really cost a whole lot. Try to set up a business account so there's a little bit of separation, and you can understand a little bit about what's coming in and out of the account. And business credit cards, if it makes sense, get a business credit card just so you can separate all the expenses and benefits. And if it's possible, even if you have 3 to 5 employees, or if you're a contracting team of 3 to 5, there's a possibility of getting small business group insurances. So those are possible with a lot of companies. So just find out about them. Find out what caters for your business. And when we're looking at 6 steps, when we're looking at a financial plan, a personal financial plan, a business plan, although your business structure plan is going to look different, but if you're setting up a business and you're setting up a personal plan for yourself, they're going to have some of the same aspects. So first thing you're going to want to know is cash flow. So oftentimes when I sit down with individuals, it's not a problem of spending. Sometimes it's a problem of what's actually coming in. A lot of people don't actually understand cash flow, and that's how you that's how you start overspending. That's how you spend without your means, not within your means. And next thing people need to understand is debt management. Debt management is so important. So looking at where that debt is occurring, understanding good debt, bad debt, and also knowing that debt is something that's going to work with you. It's going to be a part of the process. And it's always about habit and consistency of paying it down. But there are definitely some strategies to debt management, especially when you're starting out a new business. Costs are going to be a little bit higher. There's a little bit of a learning curve. You're going to have to set up new technologies. So understanding that debt is going to be there, but it's not something that you need to worry about as long as you have a strategy to pay it down. And thirdly, I really want to mention this, is an emergency fund. So Jana said it best, having a plan, a preparedness plan for your business. And when COVID hit, we had some amazing businesses that weren't able to recover. And a large part of this was because they had no preparedness plan and they had no emergency fund. So this is 3 to 6 months of your income set aside in a place where it's liquid, where it can be accessed quickly. So that doesn't mean that it's not invested. It doesn't mean that it's not going to grow and it's just going to sit there. It just means that if you have it in place, it's liquidatable. It's accessible to you and your family in times such as these, COVID. And I sat down with a lot of clients that couldn't survive 1 month without CERB. So emergency plan is so important. And proper protection. So 50% of Canadians have no protection. So sometimes people don't really understand what protection's for, and they think that protection's there, it's just a money grab, or it's not there. But I'll let you know, the majority of my clients, especially young individuals that ended up on my caseload, it was due to lack of proper protection. Either their ability to earn was not protected when they got sick or hurt, or their life wasn't protected and their family ended up in a bad situation. So it's such a key importance. I can't emphasize it enough. And then when you're talking about building wealth, so where is all that money going? When you are putting away wealth, and a lot of people think that a part of building wealth is having wealth. I'm going to let you know, wealth happens at any group, any type of income level. It happens with habit and consistency. And lastly, what are you doing to preserve that wealth? What vehicles are we putting it in? So these are all a part of a sound plan. So a personal plan is going to be key importance, and it's going to float across. So when we look at proper life protection, what is it for? It's to pay off any debt, replace any income, and have peace of mind for yourself. So knowing if something does happen tomorrow, that your family's covered. And if you need to pass on a legacy, you want to pass on a legacy to your family to make sure that they're secure, that you have it in there. And life protection is tax-free in Canada. So a lot of individuals don't know that. And Jana and I and Andrea will talk about a lot of this tomorrow, is probate. So that's the provincial taxation process. Life insurances pass that taxation process because it's an insurance and it goes to your family directly. And I won't cover the 2 types of insurances, just know there are 2 types. And one is covers you till death, which is the permanent, and term covers you for a term of time. So something's better than nothing, even if you're a small business beginning, and even if this is a side gig, look at a little bit of life protection for yourself and your peace of mind and your family. And the younger you get it, the cheaper it is. And secondly, I really want to focus, I cannot emphasize this enough, business individuals, sole proprietors, and not even side giggers, but people that own their own business do not qualify for employment insurance unless they directly pay into it. So it is so important to make sure that you have your ability to earn protected. And keep in mind, not every EI claim gets approved. So I was talking to my husband today, and he said that he was just speaking to an individual that he knows, and his EI claim got denied. This gentleman has a mortgage, he has children, and you know, it's happened. So disability insurance is so key for individuals that own their own business, or even if you're working, because disability insurance has a little bit more liberties to it. And very, very important when you own your own business. And the second part of that is critical illness insurance. So if you get sick or hurt, who's going to pay the bills? So who's going to be able to do that? So that's a part of that preparedness plan. And I'm going to let you know that it's happening so much more and more. Today we got a note from one of our other advisors or fellow individuals that her client, they put in protection about 3 months, not even 2 months ago. And she's 38 years old. She got diagnosed with cancer. So it's just happening more and more. I cannot emphasize it because more than 50% of Canadians do not have any protection at all. So this is the things that derail your plans. And I also want to emphasize business overhead insurance, especially if you have a brick and mortar shop. So if you get sick or hurt, who's going to turn the lights on? Are the lights going to be able to stay on? Are you going to be able to cover that lease? There's so many issues that go on there. And business liability insurance, especially if you're a sole proprietor and you're working with clients on certain projects, you have a small staff or a contracted staff, it's so, so important. And individual health insurance, so extended insurance, because as I don't think a lot of people understand, even though we have free healthcare, it doesn't cover everything. So see if it makes sense. Get somebody to run the numbers for you, and something's better than nothing. And when you're looking at debt and savings, I talk a lot about this where I said debt management. Look at balancing your debt and savings ratio. What's coming in, what's coming out, and that short-term, long-term savings. So remember, all of this happens slowly. So it's you like an ant or me like an ant, just building and storing myself for the winter. And each time I get, or making that molehill, whatever you want to say it, I'm just building it slowly and consistency. So you don't need a big amount of wealth to build wealth. You need consistency and habit. So whether it's that $25 a month that's coming out, whether it's $25 biweekly, whatever that looks like for you and your family, it's so, so important. And whatever that looks like for you and your business, it's so, so important to have a little bit of money set aside, and that's growing for you, not only short term, long term, and also having that emergency plan in place. And as we see in COVID, it's so, so important. And just as a side note, a lot of people put more money towards their debt, and sometimes it makes sense to put more money towards your debt, but you always want to make sure that if you are putting some money towards debt, there's a little bit of money going towards saving. So that's your emergency fund, you're investing, your short-term savings, and you're putting a little bit aside each month. Even if it's $10, that $10 belongs to you. And it belongs to your rights, your family, and putting that plan together for yourself. So just a quick reminder, in COVID-19, I want to congratulate all of our business owners, because you could have ran away and said that, I don't want to do this, I don't want to be a business owner, but we have so many individuals that instead of shying away, they became innovative, they became stronger. And they actually said that I'm going to become a business owner and I'm going to innovate whatever is happening out there, and I'm going to make this landscape work for me. So I want to congratulate you. And also, we want to help you try to get a foot up. So right now, interest rates have never been as low as they are now. This is a good opportunity to consolidate any debt, put it on credit lines. So if you have a large credit card bill, so I am running into a lot of individuals that have a lot of credit card debt, and you have the ability to consolidate it and put it in something where it's lower interest and it's not going to grow against you. And mortgage rates have never been as low as they can. So if it makes sense with yourself, your family, and with your bank, if there's room, you can consolidate that debt into your mortgage. So it's so important right now, especially in COVID. A lot of people have racked up quite a bit of debt. Talk to your bank. Go and talk to them. Say, hey, can I get a credit line? I'm putting so much interest onto my credit card, because most credit cards are 19.99%. So I'd love for you guys to sit down with me. I would love to do something called the Rule of 72, where I teach you how compound interest stacks up against you, and it also works for you in a certain way. So I welcome that call, and I welcome that the way I can teach you how that formula works. But consolidating your debt is so important, and we have the ability to do it now more so than ever, just because a lot of rules are being relaxed and a lot of people are understanding what debt looks like. So please take advantage of that if you can. And if you run ODSP, the student loan in Ontario, sorry, so from Vancouver, I want to say Vancouver student loans, but if you're running student loans from Ontario, keep in mind the interest rate on that is 5%. I'm having a lot of people consolidating that debt along with some other pieces of debt into other interest rates that they've gotten. And the interest rate ends up being 8% or 10%. And they've taken that loan and they're trying to consolidate it, make it one payment, but they're not looking at that interest. So keep in mind, the student loan debts are about 4.95%, and they have a lot of flexibility. So you can call student loan if you're unable to pay that debt. I highly recommend sitting down with somebody. So when we talk about investing, guaranteed income certificates are one way of investing in Canada, but it's low interest and you grow below inflation, and it's locked in. And a lot of times you don't have the ability to take it out. So that's when we talk about that liquidity. I'm running into a lot of people that have locked in money and they're not able to redeem it because most GICs are non-redeemable. So keep that in mind. And bonds are another way to invest in Canada. It's medium risk, medium return stock. It's like the New York Stock Exchange, but we have the TSX. This is like Apple, this is IBM, all those companies out there that are stock exchanges. It's high risk, high potential for return, but it's harder to diversify because most stocks cost a lot of money. So I think the Visa stock is about $235. So it's harder to diversify because you're unable to purchase more than a few stocks at a time. So best bet is for a lot of business owners that are starting out and new investors are investment funds. So a professional money manager looks after your money. You're able to diversify because you're able to buy a unit of a unit of a unit of a stock, and they have more downside protection. So if you put it in certain types of investment funds, because a professional money manager is managing it, they're able to take money in and out, and there's potential for higher returns because somebody's watching how the market works for you. And examples of that are ETFs, mutual funds, and segregated funds. So when we talk as business owners, we talked a lot about liability. And one of the things that people don't understand is some products are better than others. So while insurance is creditor protected as well, so are segregated funds. So mutual funds are amazing in a lot of ways, but there's sometimes a little bit of problems with creditors. So they're not creditor protected. and there's no protection on that amount. So if the market falls and you lose 100%, you lose 100%. They might have lower fees, which are amazing, but in long term, they actually end up being a little bit higher because there's transfer fees, redemption fees, and professional fees that are added to that when you go to take them out. And they're subject to probate. So they'll go through that provincial taxation process, and probate fees will also apply. And when you go to segregated funds, I'm going to go to that fee section. The fees look like they're a little bit higher, but redemption and professional fees won't apply. And there's a lot more benefits because they pass the probate process, they're creditor protected, and there's guarantees on that principal amount. So if I put in $10,000, I can insure that entire $10,000 principal amount. Nothing happens to it, even if the market falls to zero. And what happens there is, if markets are falling and I have a protected amount, it means that I don't have to catch up as much. But there's great benefits to segregated funds, and they classify as an insurance product, not an investment product. That's why they pass probate, and there's a lot more benefits to them. So GICs, bond stocks, these are the things that go into RSPs, RESPs, RDSPs, open half-taxed products, and TFSAs and permanent insurance. So I want you to keep in mind, when you put your money in, we want to try to be as tax efficient as possible, as Andrea already covered. And we want to make sure that our TFSAs and permanent insurance, where there's less tax, that's sometimes the best place to be. So sit down with somebody and cater that plan to which products are going to work best for you and your business, and what services are going to work best for you and your business. And just a few tips when I'm finishing up here. So protect your earnings. Again, that coverage is so important, insurance coverage, especially for sole proprietors. If you break your leg, construction workers, they're contracted out, or if you run your own plumbing business and a toilet explodes on you, it has happened. I've heard of it. So there's so many things where a lot of people don't understand their risk. They understand their benefits, but they're not understanding what could go wrong. So investments, a lot of individuals put all of their eggs in one basket. Diversify your investments. That's the best way to go. Segregated funds versus mutual funds, and also managing old pensions. So if you're looking at it, you always haven't been self-employed. You could have been, but if you're not, you could have worked for a company and received a work match. So look into those old work matches. They don't follow you. You have to follow them. So you actually have to manage them. And tax efficiency occurs in permanent insurance policy. They have a tax shelter inside of it where you can put money and borrow it at a later time. And RSPs and TFSAs, when you look at that, you get a tax credit when RSPs get put in. TFSAs, when you go to pull them out, there's no tax implications, whereas RSPs there are. But which ones? There's normally a fine balance. And also, a lot of business individuals don't know this, but spousal RSPs, you get that credit and you get it on your wage, but you can put it in your spouse's name. This in future reduces tax implications. And tomorrow we're going to talk a lot about this. A lot of business owners don't have this, and this is part of that succession pieces, estate planning, will planning, making sure both spouses are protected, because the family functions together. So if one spouse dies, how does a family take care of children or loved ones? So it's so important. And I'm going to skip this here because we're kind of running over time, and we'll move over to partnerships, where we are going over to Andrea, I believe.
Yes, thank you, Neru. So regarding the partnership, this is another business structure. Usually the partnership, it's a relationship between, could be a relationship between two or more individuals. It could be between individuals and corporation, or individuals and trust, corporation and trust, all the possible combination. that's why, because it's so complex, requires a lawyer and requires a partnership agreement, which is usually prepared by the lawyer. And in that agreement, it will show the profit sharing. Each partner may contribute money, labor, property, skills to the partnership. In return, they will be entitled to the profits or losses, regarding dividing among based on the partnership agreement. So it depends of 50-50 or 20%, 80%. It depends how you agree from the beginning, and that is how you will calculate your profit, and you'll declare it also for income tax return. A partnership is not a separate legal entity from its owners, the same like sole proprietorship. So all the liabilities fall still on the owners. There are two big types of partnership in Ontario, which is general partnership and limited partnership. For the general partnership, each partner shares the management and remains personally and legally liable for the company's debts. For the limited partnership, there is a general partner which manage the company, and other limited partners, could be one or more, that contribute only financially to the extent of liability and profit sharing. All this, as I mentioned, profit sharing proportion needs to be very well defined in the partnership agreement. A partnership by itself does not pay income tax on its operating results and does not file an annual income tax. At tax time, each partner itself files the personal income tax based on the or corporate income tax or trust. It depends which form of organization they are in. The partnership itself will at the tax time only files an information return. So each partner itself needs to file financial statements, and the shares, their shares in the partnership needs to be kind of reported in the income tax return. On the next slide, I would like to mention a little bit about, not this one, the next slide, Niru, please. That will be a joint venture. Joint venture is a type of partnership. A joint venture, it happens when two or more participants pool their resources for a specific task. Each person involved is responsible for the profits, losses, and cost of the venture, which is separate from their other business interest. Joint venture does not have to a separate fiscal period from its members for taxation purpose. Each participant in joint venture should include in income for a taxation year its income for the joint venture up to the end of its taxation year. If there are various participants in joint venture and they have different taxation year end, the profit of the joint venture should be computed at each participant's taxation year end. There is no capital cost allowance for joint ventures, so no depreciation should be deducted on joint venture income statement. That is because each co-venturer will set up their own capital cost allowance schedule for their share of the total cost of the asset, and each co-venturer independently decide how much depreciation wants to deduct each year. Joint ventures instead has to prepare financial statements. The lawyer should describe from a legal perspective the terms related to the expenses, liabilities, profit sharing for each participant in the joint venture agreement. So this is just a few tips about joint ventures, and I will let Jenna know, who is an expert, legal expert, to talk more about the partnership.
Thanks very much, Andrea. All right. So again, to summarize some pros and cons for someone considering entering into a partnership or setting up their business as a partnership. So the pros is, Andrea's already mentioned, the ability of the partners to pool resources. So where the sole proprietor is like, you know, a one-man show and you're just using your own funds, this allows for multiple people to be able to, you know, pool startup funds together, and that gives the partnership a bit of a leg up, and also a bit of a pro and or a con, but the partners also share the profits and any losses. As compared to a corporation, the taxes are simpler than an incorporation. I mean, it's a little bit more complicated than a sole proprietor, but still not as complicated as a corporation. This is also easier and generally cheaper to set up as compared to a corporation. And now some of the cons of a partnership. So there is still a personal liability aspect to it because you are still the business, although the risks and losses are shared between the partners. As a partner, you are liable for decisions that your other partners make regardless of your involvement. So whether you were involved in a particular decision or not, you're still technically on the hook for it. And much like the sole proprietor, as a partner in a partnership, you're liable for all contracts of the business, and as well any liability or damages that are caused by your other partners or by your employees in the course of their employment. Next slide, please. All right, so some ways that you can protect yourself in a partnership is most definitely and most importantly, having a written partnership agreement in place. Do not leave it to a handshake. Do not leave it to a verbal agreement. Everything may be well and good between you and your partners right now, but who knows what's going to happen, you know, 2 years down the line when something changes and someone now wants to leave the business because they are no longer interested in it. Or if the relationship sours, then what are you going to do with the business? So some key components for partners to include in a partnership agreement is who owns what and how much. So, you know, is this a 50-50 partnership? If there are multiple partners, what is the percentage ownerships there? What does the profit and loss splitting look like? And this is especially important where there are unequal ownership in the partnership. The next big thing is who has the binding authority. So who has the signing authority? Who can, you know, is it all the partners of the partnership that can sign contracts without the other people knowing? Or is this an instance where everybody has to sign? And so putting in clauses such as this to protect against potentially a partner acting on his or her own without the consent of the other partners. And that leads into the next point, which is the decision-making process. And so, you know, if there is a decision to be made with respect to the business, perhaps with taking on a new partner, how is that decision made? If, you know, does this require unanimous agreement? Is this a majority rule? And so these are important things to include in a partnership agreement in the event that conflict arises. Other terms that are important in a partnership agreement definitely include when a partner is to leave the partnership. So whether, you know, they want to exit the business because they're no longer interested in running it, they want to retire, or they have health issues, or they've passed away. So what are the provisions around the buyout or the dissolution of that partner's ownership in the business, and also timelines tied around it? And last but not least, general dispute resolution provisions. So where there is a conflict among the partners, how is a dispute to be resolved? Going beyond a partnership agreement, something that's important for anyone in any type of business is having your own power of attorney for property. So if someone is incapacitated for any reason, like, let's say I was hit by a car and now I'm in a coma, and if I'm in a partnership with, let's say, Niru, then, I'm now, not pulling my weight in the business. So have I named somebody in my power of attorney to be able to step in? Or is there something in the partnership agreement that covers this particular gap? And then, as mentioned before, very important for all businesses, regardless of structure types, to have a disaster recovery plan and the larger business continuity plan in place. Okay, and I'll pass it on to Niru.
Hi, everybody. Again, I'm going to try to keep it short and sweet. So when we talk about partnerships, I really want to emphasize it's all going to be about the same structure, but there's so many different partnerships that can be set up: corporated, incorporated, limited liabilities. So I'm going to cover a general one that I find most business individuals going into, where your sales and commission is your earnings. You got your deductible expenses, any wage, anything that you purchase for the business. And then one, two, or three partners are dividing how profits are spent or given as a wage. So I'm going to emphasize this can happen in so many ways. And as you notice, we've already went over a little bit of time because this topic is so big. And each little point can be covered with such detail, and it can become its own webinar just on its own. So this is a general overview. So when you're looking at partnerships, Jana's already said it, have your business agreements in place. I've seen this happen. I had a client who got into a car accident, and she got some type of photo. I forgot the diagnosis, but she couldn't open her eyes for 6 months because of the light. And in that time, her business fell apart with her business partner. Things went awry. This beautiful relationship they had now no longer exists. But what it did leave behind was some financial ruin, which she's now recovering over. So it took her a long time after, and it really goes to show. So I'm not trying to be negative here, just trying to let you know that these situations do occur. So what once was is not always going to be. And we can only keep our fingers crossed. So have those agreements in place, and keep in mind a business, even if it's not incorporated, doesn't mean it's not a living, breathing thing. Anything in your life, your financial plan, your business plan is a living, breathing document. So it changes with you, your life, the economy, COVID. So continue to revisit what's happening within your business and put things in. So don't start with all the bells and whistles. That's what I'm telling a lot of my business clients is, they go off and get all the bells and whistles. Get just the necessary things to begin. And as your business grows, then add those things into your business. One thing you're able to get when you have a business partnership is something called key person or key employee insurance. So insurance on each other. And this insurance can have components of tax shelters, which is a permanent insurance component on the company, the company and on each other. So if something were to happen, then you have the ability to continue the business forward. Keep in mind, stuff does happen, and I've seen it happen. My colleagues have seen it happen. So please do notice that some things are necessary and others are not as necessary, but take it on as your business grows, and look at what your business is investing in, and look what yourself personally, what you're investing in. And lastly, what the third bar is saying, because you're not completely 100% protected, there's still liabilities that occur. Even in corporations, you're not 100% scot-free. It's always a good point to have your personal financial situation set, because everything trickles into each other. It goes back and forth like arrows. So it's so important. Insurance, income protection, debt savings, investments, all of these things are so necessary. So going back, and we're going to go back to Andrea here with corporations and business registrations.
Yeah, thank you, Nero. Business structure, like corporation, is the most complex business structure. And to start with the first step, like registration, everybody needs to register first the corporation in order to operate it. The following steps needs to be followed. First of all, to choose a name for your corporation. Then to conduct a name search. I talked about nuance when I was talking about sole proprietorship. Is the same procedure. Unless you want to operate a number company, for corporation you have this choice, but the number company is given by you by default, so you cannot choose the number. You just on application, you just opt for a number company, and then you have to use that number company on your legal documents, contracts, invoices. So just, you know, think what you really like to see on all your documents, and then, you know, do accordingly. The other step, and the most important one, is complete the article of incorporation. Which is called Form 1, and this needs to follow the regulation provided by Business Corporation Act. It's much advisable. I will advise to ask a lawyer in order to do your article of incorporation, because each industry is different. You have, if it's more than one shareholder involved in the company, in this corporation, then a lawyer, it's a must. So you have all the documents right from the beginning. If you like to incorporate, you can incorporate provincially or federally. If you do it federally, you have to apply with Innovation, Science and Economic Development Canada, and of course pay the fee. If you are doing provincially, every province is different. It's different organization where you have to apply. For Ontario, it's Service Ontario. And you have to follow their rules, like each province is different. Next slide, please, Nero. So a corporation, sorry. And the next slide. This is, I think I covered it. Yeah, okay, thank you. There are two types of corporation, private corporation and public corporation. The private corporation can be formed by one or more people, but must have the majority of the director residing in Canada. Private corporation cannot sell shares or securities to the public. Versus public corporation, these can list their share and securities to the public. They must operate in compliance with Ontario Securities Act regulation. What I would like to mention about corporation, which is very important, there is no personal liability for the debts or obligation of the company. And the shareholders' liability remains limited to the value of their investment. Any corporation has to have a shareholder agreement. Doesn't matter if you are, you have to decide actually if you want to declare common share, preferred share. There are lots of alternatives, and this is according with your scope of work, like activity. You can declare, you know, for your common shares just a minimum value of, let's say, $100, but the shareholder agreement needs to be in place. A corporation has more of a continuous existence than a sole proprietorship or partnership, and the life of the corporation is not tied to the specific individual ownership. The shares of the corporation can be sold to a different owner, and corporation will continue to exist. On the next slide, I would like to, thank you, Neru. I would like to mention, you see the two pictures, you can have a corporation, you know, from your own house. You can set a nice office in your house, or you can have a huge corporation, very nice tall building like the other pictures. Doesn't matter how you want to create that corporation, you still have to complete the article of incorporation and send the documents to the appropriate government, provincial or federal. A corporation has to file T2, it's called, income tax return, no later than 6 months after the end of fiscal year, even though you don't need to pay any taxes. The T2, it's a requirement, like financial statement needs to be provided to government levels, and you cannot escape. Doesn't matter if your corporation is a small corporation or large corporation, doesn't matter of the size. The tax year for a corporation, it's the fiscal year. Fiscal year can be set up by the owner, and it's not a specific days that is required. You can do any day, any month of the year that you prefer. Corporations also have lots of reporting periods for which they need to file the GST HST return. So the sales tax, they have, if they have employees, they need to report the source deduction, CPP, which is pension, contribution to pension, EI, which is unemployment. All this, so if you have, for example, salaries that incur in the month of September, all the deductions are done by the 15th of the following month. If you are a small corporation, those deductions can be remitted quarterly. You will receive a notice from the government, from CRA, when you open your payroll account, and in that note, they will state your deadline for these deductions. If you don't want to pay as owner of the corporation, if you don't want to pay yourself salary, you can decide to pay dividends if you have a nice income at the end of the year. That dividend that you pay, it's after you pay the taxes for the corporation, and as a personal income, you have to declare it when you, as owner, when you file your personal income tax return. So, and at that moment, you are going to be taxed for the dividend. Many owners are asking me what is best to do to pay myself dividend, to pay myself salary. To answer to that question, you know, we really need to sit down and see what are your long-term goals, what lots of variables in this decision. It depends, for example, if you are a small business owner and you like to get a mortgage, like a house in future, the banks is looking mostly on the salary and whatever you pay yourself, salary, bonuses, so on the T4. They are asking for the T4s in order to provide you with a mortgage. if you provide just the dividend, they usually don't look at that information for some reason when they grant you a mortgage. So it depends, what are your business goals and also personal goals. So everything needs to be taken into consideration when you decide how to pay yourself salary versus dividend at the end of the year. Also, when you do this, you want to take this decision, you have to have in mind as a personal, for personal tax preparation, do I have enough room to contribute to RRSP so I can lower my personal taxes? Do I have, there are so many variables, so it's not a straight answer, do this or do that. Really need to analyze all these situations, and I strongly advise talk to an accountant. I'm available to explain this process and to walk you through all the scenarios, and then you will take the decision that fits your needs. On the next slide, Niru, I would like to quickly touch on a professional corporation, which is a type of corporation that, but this is very regulated. The business owners are usually the professionals, like doctors, lawyers, accountants. And when a professional corporation is its form, usually the corporation is a separate legal entity, and the shareholders, which are the professionals, and they need to be also directors, must be licensed by their professional association. For example, as a CPA, I'm regulated by certified professional accountant association. Lawyers are regulated by Law Society of Ontario. So the corporation is usually following the regulation of the profession, and there are some limitation and strict condition that you have to meet in order to open this professional corporation. Now I will let, I think Jana, she's next to talk about more legal consideration. And if there are more questions about the corporation from tax point of view, I will be happy to answer them at the end.
Thanks very much, Andrea. Okay, and I know we're running super over time here, so I'll be as quick as I can. So again, pros and cons with setting up a corporation. So as Andrea has already mentioned, big benefit of setting up a corporation is limiting your personal liability. So if the business gets sued because of a contract, because of damages, because of an employee issue, it's the business that bears the liability and not you personally. Secondly, the benefit of setting up a corporation versus the other types we've talked about is the ability to raise capital. And third, sometimes it's optics. If you are so-and-so from ABC Incorporated, it might have a better ring to it than Jana Sang, sole proprietor. So sometimes people give some credence to it, sometimes not, but that's a potential benefit. And again, as Andrea has already mentioned, there are income deferral opportunities, there's income splitting opportunities, depending on how you want to set up your business and how you want to pay yourselves and your employees, and potentially income sharing with respect to spouses and family members. But all of that, I mean, I think it's very situation specific. And so definitely talk to an accountant before you decide on a particular course of action. The other pros is the tax rate and tax credits that are available to corporations. And corporations also allow for continuity in estate planning. So the one big benefit of a corporation in terms of passage of private corporation shares of a family business is that currently the Ontario legislations allow for private corporation shares to be passed to your beneficiaries directly and outside of the probate process. And what that means is that, you know, let's say the corporation is worth $1 million. If it went through the probate process, it would be taxed at 1.5%. I mean, it's a bit of a graduated calculation, but that's what it would be calculated. That's what the tax payable would be. Now, if the owner of the corporation was smart and set up a secondary will for the passage of shares directly to the beneficiaries, because the Ontario legislations allow it, then that $1 million does not get taxed at a probate level. So definitely a very big piece in terms of estate planning. Now, some drawbacks of a corporation, as we've already mentioned, high initial setup costs and also much higher ongoing administrative costs, like, you know, you're paying for an accountant to do your books, potentially to make sure that, you know, you are doing everything properly. You may have to hire a lawyer for your annual return filings. So all of those expenses do add up. There are no personal tax credits. There's much more paperwork that's involved. So like I mentioned, there's a completely separate income tax that needs to be filed because a corporation is its own legal entity. And then also, you know, there are associated annual returns and shareholder meetings that have to be held and that type of thing. So also a potential drawback is the increased complexity in your business structure. So unless you have a really good grasp of, you know, how your corporation is set up or is run, or, you know, when someone gets into multiple corporation scenarios where, you know, you have a holding company on one end that's tied to this particular company, but you have a third corporation that's doing something else, that can become very complicated quickly. And also in terms of winding down a corporation or closing down a corporation, there is a big process, lots of paperwork associated with that as well. Next slide, please. Okay, so for corporation, how do you protect your business? Very similar to the partnership piece that I've talked about. Very, very, very key to have a shareholders agreement in place when there is more than one shareholder. Do not leave it to a handshake, even if you're in business with your spouse or with you know, family members. It's sad to say, but unfortunately, relationships do sometimes change. And so you want to have a shareholder agreement that you can fall back to in case there are disagreements, in case there are conflicts, and also, you know, in the event of someone wanting to leave, what does the buyback look like? Or if someone passes away, what is the treatment of the shares? How long does the corporation have to buy out the deceased person's shares and those types of things? So I've included some examples of key components of a shareholders agreement. It's not an exhaustive list. What needs to go into someone's particular shareholders agreement depends on what they are doing with their business. And like I mentioned before, very important to have powers of attorney for property in place. Also, you know, to have your will in place, and especially if your intention is to leave a legacy for your next generation, and to minimize the taxes that are payable on death, then having that secondary will help you achieve that goal. And last but not least, you know, we've already talked about the importance of having a disaster recovery plan and also a business continuity plan. All right, and now I will pass it off to Niru to talk about the final aspects and to wrap up.
So I'm gonna actually skip over a lot of this piece here. So we talk about when we're investing in a company, and we're looking when a corporation is investing, we're looking at corporate holdings. So this only matters if your company having a significant amount of money that's coming into it. And you have the ability to start investing. So a holding company is set up by the corporation, the operating corporation, and what they do is they hold money there, so it won't be taxed in the same way. It won't be taxed because it's not being used. But it doesn't mean that it just can sit there and not do anything. That's where you can use it for insurances, non-registered investments. That's where you can buy real estates and other investments. And your company can hold that money or just hold extra money to decide what to do with it. So this is where you're going to need a accountant to set up a holding account. And this is not going to be for everybody. So keep it in mind that when you're setting up a corporation, the corporation is a separate entity. It's almost like you're paying yourself as an employee of that. So depending on how you want to pay yourself, which Andrea and Jana already covered, really depends on the structure of your corporation. And corporation, there's not one size fits all. It's really, it depends on your goals, your dreams, your projections. It depends on what's happening out there in the economy. Are you taking on new technology? Are you innovating? Are you able to apply for grants? A lot of corporations are allowed to apply for a lot more grants and credits that are not available to other types of companies, but they only applies if you're doing certain types of things. So corporations are sometimes really, really difficult to talk about, but there are certain ways to invest and put yourself in better positions when you're talking about corporate investing. So we got asked this question quite a bit, and I know we're a little bit over time, but one way to invest and have less tax liability is corporate life insurance. And these are the advantages, and I'm not going to go through every single one of them, is when you set up certain types of life insurance policies that have something called a tax shelter, and those are permanent policies. So they'll go till the beginning of your life, till the end of it. So when you pass away, the money in it goes to your family. And if it's a business policy, it goes to shareholders. And there's tax implications are there, but they're lessened because it's a life insurance policy. And if it's a company-owned policy that the company's paying for, the money isn't coming out of your pocket, but your company is saved in a certain way, especially if you have limited partnerships, corporate partnerships, shareholders. It's a net that's paid to the shareholders, and it also covers key person insurance, and there's just so many more benefits to having corporately owned life insurance and investing inside of it, because it has something called the tax shelter. And what you can do is you can put extra money in there to flow towards the shareholders or family members at a later time. And you can use it within your lifetime as well, but you borrow against it. And when it's set up corporately, it's set up in a different structure than it would be personally. So personally and in corporate environments, life insurance is key to passing and growing wealth. So if you've ever noticed how, rich families in North America tend to stay rich, a lot of it's due to permanent policies. Because you're passing on wealth tax-free or with less tax implications, because there's so much room to save taxes. So keep in mind, these are not even all the benefits. Snap a picture if you want. And the disadvantages to having insurance, corporately owned insurance, is you're not creditor protected, because if something goes wrong, and say, for example, the corporation isn't 100% foolproof, it has way more protection than a regular business, any type of, gig worker or side account worker, or somebody with a partnership. But there are ways that you're not foolproof. So there's not creditor protected, and you may have some tax implications once you surrender the cash value on the policy. So because it is considered an asset of the company. And when you look at corporate investing, there's no one size fits all. So your corporate investing has to do with a corporation, but the corporation doesn't have a SIN number. So ways to invest are real estate, non-registered, but they can't be repurposed in the same ways that personal insurance or insurances or tax shelter insurances can. And insurance policies that I just covered. So those are ways to invest, but it's not a one-size-fits-all approach. It really has to be catered to your corporation, just like Jana and Andrea already addressed. That's why it's hard to go into a cookie cutter approach. It's really a case-by-case basis. And this is a group effort between your financial professional and your accountant, and also when you're setting it up, the legal professional that you're working with. So it's kind of a marriage between all of us that would be assisting you in this process. And it is all based on money that you're keeping, what you're keeping the money for. So if you have a holding account, what is that money for at a later time? And again, everything will depend on the size and scope of your corporation and what its goals are and what it's made to do, and what is the revenues coming in. And all of it will depend. It's all going to make a sound plan. I'm just going to go over some corporation tips. Keep in mind, corporation investing, non-registered tax shelters with the investments, and sorry, I didn't add real estate on there, but it happens in due time. So when your corporation's a baby, think about it as a baby growing up. You don't need all the bells and whistles, and sometimes you won't qualify for all the bells and whistles in the beginning. It'll happen over time and incorporating. So I'm running into a lot of professionals that have said, oh, I'm going to incorporate because I heard it's a lot of more protection. I hope in our presentation, you've kind of found out that incorporating is cool, but it's a lot of expense, especially when you're a new entrepreneur. And really, if you're taking on 1 or 2 contracts, look at what you're actually doing. Is it worth incorporating right off the bat? So my first question is to everybody that I sit down that wants to incorporate, do you know why you're incorporating? And keep in mind, you can incorporate at a later time. Once you incorporate, you can unincorporate. So I do have clients right now that will be waiting for the following tax year, and they're going to unincorporate because incorporating didn't make sense for their company, and it was a little bit too expensive with their fees, depending on because their company didn't generate the profits that they thought it would. So keep that in mind, and make sure, even though they say corporations are foolproof, if your personal finances are not in order and you end up with creditor problems on your personal finances, every wage or everything that you bring in from your corporation, your personal taxes are still going to be there. Your personal liability is still going to be there. So your corporation could be intact, but your personal finances are a mess. And I am running into people with those problems. So it does happen where you kind of need to do a little bit towards both. So having a sound plan on both sides, because eventually your personal finance problems, emotionally or even financially, will trickle into your business as well. So, and just understand that your corporation is a living, breathing individual. It's an entity. So it's going to grow, and you'll walk up the ladder easily and quickly. So don't make it so big in your mind where you have to grow everything so quickly. Walk up that ladder slowly, get those accounts, get those investments, do it slowly but surely. It will definitely happen. I'm finding a lot of people want to set up all of those things, but they're not really qualifying for them because there's nothing to hold. So, so there's a lot that goes into corporations. I could go on and on about it, but I won't. And I'm going to give it over to Andrea. We're just finishing up here, and we apologize for going over. Again, each single piece that we're discussing here can be a topic on its own. Sorry about that, I skipped word.
Okay, I unmute myself. I don't know, I got weird messages on my screen. So the last point that we wanted to cover is the NGO, which stands for non-governmental organizations. Usually the NGO is a not-for-profit group that functions independently of a government, and they are usually organized on community, national, international levels to serve a social or political goal, such as humanitarian causes or the environment. Non-governmental organizations are funded through membership dues, private donation, grants, the sale of goods or services. I will stop here because we presented so much information, and probably Nero has to say something because she worked in those type of organization before. So just to wrap up, and I think we went so much over the time, so I apologize for that, and I'll pass it on to Nero now. Thank you.
Hello, everybody. Just wrapping up here. I did spend a long time working in nonprofit organizations, but nonprofit organizations, a lot of people think it's a type of business, charities, all those things. You pay yourself like any other employee. So it would be the NGO earnings, employee deductions and costs, and you equal your employee paycheck. You do get reimbursed for expenses such as your gas mileage, and that's something you should definitely sit down and talk to accountant about, because your NGO should be refunding you that money back if it goes into your contract level. I know some NGOs don't do it, but it's really like being an employee. So that means your personal finances have to be in a better position. So just always emphasizing personal finances. That's your key, that's your foundation, no matter what level of business that you're establishing. And the business is a function or secondary to whatever else you're going to do. You are the foundation and you are your business. So please keep that in mind. And we are all done, and I'm going to hand it over to Aisha to just close this off.
Thank you so much to all three of you. That was so informative. We do have a few questions. Although you've answered them in the chats, I would like to ask them so the viewers, it is helpful for the viewers. So the first question was, can you please explain how to make CPP contributions if you have an earning on sole proprietorship? Is it done at the time of filing returns?
Yes, that's true. It's done when you file the personal tax return T1.
Okay. The second question is, can you get external investors in joint venture?
Yes, you do.
Okay, those are quite simple for Andrea. Okay, Corporations Canada website says if you are the only owner, a shareholder agreement is not required. What are the cases in which you would need one, even if you are a single owner?
You have to get a shareholders agreement. Doesn't matter if you are one owner or 2 or 3, or doesn't matter the number. You have to get a shareholder agreement in place, because you have to state the shares, the type of the shares, the value of the shares. As a corporation, you need to be a shareholder as well.
Okay, so I think another question was, for Nero, how important is it to have your financial stuff in order? Because business is different from your personal finances, right? So
I can't stress it enough. It's so important to have a basis of your personal finances, and keep in mind, you don't need to be wealthy. A personal plan is just something small put in place. If your budget is $200, it's $200, and that's what it's going to work in. But a sound plan has certain facets to it, and whatever you can get done. If you work with a financial professional, they'll work within it, within your budget, whatever you can do. and they'll find the right services that are there. Because definitely if your personal finances are not set, as I've already said, it'll trickle over into your business eventually, because that's where you start having cash flow problems, especially during down times. So a lot of people don't, a lot of people don't realize that in the beginning or during down times, that's the times when you pay yourself less, or that's the times where you put money into your business to grow. So if you don't have any personal finances, or you want to establish extra to your business, where is that extra cash flow going to come from? And even if you're going to take out a loan and your business is new, oftentimes there's personal liability attached to that. So there's so many things that go into it. It's really case to case basis, but your personal finances should be done because it's your own life. That's your foundation. And more Canadians are retiring in low income factors. So we just need to help people in that sense.
Okay. Thank you so much, ladies. It was so wonderful to have you as our experts, and you really took the time. You did your research, or you're already experts. You don't need to do the research. So you were wonderful, and we have finished our newcomers to Canada. We finished relationship status, and we finished business structure. Now we have the last in the series, that is estate planning on October 1st, just 2 days from now. So we will be back, and this time hopefully we'll be within the time. So thank you so much for everyone who's watching, and take care. Have a good night. Bye.
Bye. Have a good night, everybody.